down and you think.
Okay, we're good to go, I think. So first of all, thank you everyone for attending both in person and online. So I was just saying to Chelsea, we've been playing around with the technology on this one, so apologies in advance if something goes astray. Chelsea's monitoring from the back of the session. So if you're online and something goes wrong, just let Chelsea raise your hand, or I think it would be, or put a comment, and then Chelsea can look into it. So again, welcome everyone to our session on tax planning, 2021 tax planning, which will also incorporate the changes that have been announced in the budget. Not that there's a lot in this year's budget, but still worth going through some of those changes. Interactive, so again, trying to deal with remotely as well as in person. If there's any questions within the forum in person, please just put your hand up and ask the question. And similarly, just in the remote session, if you just type in a question or put your hand up, and then we can pause and answer that question for you. So let's get started, and hopefully this. All right, yeah, just bear with me. I'll get the first one going with the screen. Okay, so I've always got to start with a general disclaimer. It's just bear with me. I've got to move. It's not going to work. Sorry. So I'll have to work this out in a minute, but always this is general advice only. So don't rely on anything that I'm telling you here, because it may not be in terms of actioning it from today's session, because it may not be relevant to your personal circumstances. So just be aware of that. So please just take this as general advice. If there's anything further you want to discuss about any of the matters that we raised today, then please, yeah, we can talk about that further. So let's start tax planning for business. I'm still not happy with that. Hang on. I'm going to minimize that. Just bear with me. Chelsea, I don't know if you want to try and.
If you minimize it, it's not affecting how the slides are
Okay, but people may not see me, but that's okay. So tax planning for business. So let's talk about business first of all. So just quickly, the tax rates for the 2021-22 year. Now, and a comparison to the previous year. So this current financial year, it's based on your turnover. So if your turnover is less than 50 million and you're a company, your tax rate is 26%. That's if you're a trading business. If you're not a trading business, but it's just a purely investment vehicle where you're earning interest and dividends and so on, then the tax rate could be 30%. I'm not going to say categorically will be. They have this thing called the base rate entity rules now that have come in place in the last couple of years, and it depends on your activities about whether you meet the criteria to get a 26% tax rate or a 30% tax rate based on a turnover of $50 million or less. For the 2021 to 22 year beyond, the tax rate is actually coming down to 25%. So there's a window, a small opportunity for some tax planning by pushing income or pushing income into the next financial year, or bringing forward expenses into this year, so you can benefit in a lower tax rate potentially next year. As I said, this is all based on what we call the base rate entity rules. Some people may not fit that criteria, and therefore their tax rate will be 30%. So it's either those two, 26% this current year versus 30, or 25% next financial year versus 30. So they're the new rates that are coming in. If you're not a company, if you're a trust, then it depends on how you distribute the income from that trust to the beneficiaries, and therefore what their tax rate is. And then similarly, if you're a sole trader, then they have a different rebate, which they give you an 8% discount on your tax based on your turnover, up to a maximum of $1,000 a year. So it's not a great deal. So if you're a business operating through a company, that's where you get the most benefits from the tax rate changes that are coming through. So what strategies can we look at for a business? And there's quite a few. Now there's some things that were announced in the budget which not really that significant, but there's a couple that will be. So everything is subject to cash flow requirements. There's no panacea to reducing your tax liability without you having cash to be able to make a contribution to something to reduce that tax liability. So you can't just say, oh, look, I'm planning on spending this much money on a piece of equipment in a year's time. Therefore, because I'm planning to do that, I can get a tax deduction this year. It doesn't work like that. You've either got to purchase the asset and then borrow to purchase that asset, or have available cash to be able to then get a tax deduction. For businesses with turnover less than $10 million, you can prepay things. So examples, you might prepay your rent. So you've got a rental agreement where you're leasing your business premises like we are doing here, and you might have rental where you're paying $15,000 a month or $5,000 a month, whatever it might be. You can prepay up to 12 months worth of your expenditure on that rent and get a tax deduction this current financial year. So if you've got $10,000 per month and you write a check for $60,000 for the next 6 months, then you can claim that as a tax deduction this year, even though it relates to the next financial year period, because you've physically paid that in cash. So very important to understand that you've got to physically pay it to get that prepayment. And that's what it is. So you can't just get an invoice, say to the landlord, look, can you raise an invoice for me for the next 6 months rent? Therefore, I can claim it. You've got to physically pay the rent to be able to get that tax deduction before 30 June. Other things too. If your turnover is greater than $10 million, then you can generally only write off things, prepayments for up to $1,000. So not going to give you much joy if your turnover is greater than $10 million. Wages paid to spouses. So a lot of things we do is we pay spouses and children within a family business. You can do that still, but you've got to make sure that's arm's length and it's for work actually performed. So you just can't say, oh, look, you know, my son is 20 years old, he's not working, therefore I can just say, oh, I'm going to put him on the books and pay him a salary of $50,000 even though he's doing nothing for the business. That's not acceptable because you've got to show that they're actually performing work for that amount that you're paying. So, but if they are generally doing work within your business, you can pay them, and it's just got to make sure that that's in an arm's length commercial basis, that it's not excessive to what they're actually doing, but definitely available to you. You can also buy replacement equipment, and I'll cover that a little bit further in terms of the capital allowance write-offs and the instant asset write-off, how that works. But that's one that there is substantial benefits that are available. Also, if you've got equipment that you might not be using anymore, that you've thrown out, or it's no longer working, you've got old computers that you've thrown out or they're useless now, then you should be going through your asset register and actually looking at all the fixed assets in your business and saying, no, that's worth nothing, we don't use that anymore, scrap it, actually dispose of it. And then you can write that off. So if it's got any value left in it from a depreciation point of view, so let's say it's got $1,500 worth of value still, something that you've got in your business in the asset register, but it's worth nothing and you're not using it anymore, scrap it, and then you can claim that tax deduction for that $1,500 that's still shown in the books. So a really important one too. So just a bit of housekeeping, really important to do that. Also consider delaying sale of assets. So again, if you're thinking you're going to make a profit on an asset, we've got clients where they might have substantial equipment and we depreciate it at a much faster rate than what the actual market value of that reduces by. So if you've got situations where you've got an asset which you know you're going to make a profit on, maybe consider deferring that till after the end of the financial year. So it's not coming into this financial year, it's going to the next financial year. So just looking at those things where you can play around with the tax year end. Now we've got 6 weeks to go until year end. So, you know, a bit of planning within the next 6 weeks can give you some benefits by delaying tax. And the other thing too is by getting these tax benefits this year, that reduces your tax liability this year. Even if that's a deferral until the next financial year, at least it gives you another 12 months before you have to pay that tax. So it gives you a cash flow benefit as well as a tax deferral or a tax benefit. So it's really important. Review valuation of trading stocks. If you carry a lot of trading stock within your business, again, we can revalue that trading stock if it's perishable or if it's not recoverable at the value that you paid for it. I'll always make this example. Let's say TVs, technology changes so constantly with TV. So you might have made the latest and greatest model last year where you as a business bought it for $2,000 to sell it for $4,000. Now, because there's a new TV that's on the market that's much better, you have to discount the price down to $1,800. Because you can only recover $1,800 potentially for that product, even though you paid $2,000 for it, you can write that asset down to $1,800 and therefore get a tax benefit for that $200 revaluation. So really important, again, if you carry stock within your business, to go through that stock and make sure that you're writing off or writing down stock if it can't be recovered at the cost that you paid for it. And then also the other thing too to keep in mind with these things is that if you know that your circumstances, your business is going to change from one year to the next, then you need to look at that in consideration. Obviously, we've had COVID-19, which has had an impact on some businesses. Some have done really well in this financial year and may not do as well next year and vice versa. So again, look at your situation to see whether you can do some things such as deferring income or bringing forward expenses to shift profit in effect from one year to the next to be able to then utilise this change in circumstances of your business. So there's a bit of planning that's required in this. What we do with our clients a lot at this time of year is we do projections of what we believe their income will be for the year. So we might look at the April figures as an example, and then we project out what the profit looks like for the year end, give them an idea about what the tax liability will be. And then from there, we can then give you ideas about what strategy you can put in place to try and reduce your tax liability. So that's a really useful thing to do if you're interested. Next one. Oops, sorry, gone too far. Apologies. Okay, so the instant asset write-off, this is a really big one. And the government announced in the budget last week that they're extending this beyond, originally it was going to expire on 30 June 2022. Now they're extending it out another 12 months. What this one is that, and I'm going to cut through some of the things for the current year, but basically if you buy an asset, let me rephrase. If your turnover is less than 500 million, it's actually changed to 5 billion now. If it's less than 5 billion, so hopefully that will cover everyone in this session. If you buy an asset for your business, let's say it's what am I trying to think? What could be a good example? I'm not going to say car, I'm going to think of something else. Let's say it's a laser cutting machine. If you've buy that asset before 30 June 2023, provided it's installed ready for use, you can get a full tax deduction for the whole purchase price of that asset. So if that cost you $2 million, then you can get a $2 million tax deduction for that asset. It does, but up to a depreciation cost limit, and you must show that it's predominantly used for business purposes. So now the depreciation cost limit, which down here, thank you Peter for that, down here. So for motor vehicles, up to 59,000. So if you're planning on buying that Aston Martin for 250,000, you'll get 59,000 of it as a tax deduction, but the rest will not be tax deductible.
That balance would then depreciate into the future.
It would. And then the other challenge you've got to be, which I'm not going to get into much detail on this one, is that FBT, there might be an issue because of when they calculate FBT in private usage on motor vehicles, it's based on the full value of the car, not the written down value. So there might be some adverse tax consequences on the fringe benefits side that might well and truly offset the tax benefits on getting that write-off on that car instantly for up to 59,000. So always say tread carefully with motor vehicle purchases and how you structure those, and don't be blinded by or don't think that's the overriding reason why you should do it, because there could be some other adverse consequences if you have an expensive car that you're looking at buying.
Shane,
but yeah, key thing is $5 billion, and you'll be able to get an instant asset write-off. So if you're planning on doing things, now I always say to people, don't do things just for a tax deduction, because you're going to be out of pocket, because you only get back, we talked about before, with a company, you only get back 26% or 25% of what you pay. So you're still going to be out of pocket by 75 cents or 76 cents in the dollar, or 74 cents in the dollar. So don't do things just for a tax deduction, but it's something you think is necessary to your business or is desirable for your business, and you can justify making that purchase, then this is definitely available for you. And it's actually a really good incentive. And that's why the government's put this in place, is to try and incentivize businesses to invest in infrastructure for their business and, business improvement and efficiency and so on. And that's why they're allowing this. And that's why they've also extended that now to 30 June 2023, which I'll mention later on in the budget documents as well. Yes, Chelsea.
We have a question from the Zoom chat. So George would like to know, is the threshold up to 150K only?
No,
No.
It's unlimited. So between the dates of 12th of March and 30 June, if it was purchased by 31st of December 2020, you get a threshold of 150. But then they announced this full write-off thing, so they changed that rule. So this is where, and I won't go through it, last year there was 3 different rules for this one asset. So there was different stages through the one financial year where they announced something on one day, then they announced another thing 2 months later, then they announced something else 2 months later after that, and it just got completely confusing. The long and the short of now is you're in a situation now where after this date, provided it's an eligible purchase for your business, and it's unlimited in terms of the actual cost of that asset. Yeah. So it's a really attractive thing if you've got the need to purchase something quite substantial for your business, you'll get that tax benefit. You then got to be careful, and I'll quickly touch this later on. You've got to be then careful about whether that pushes you into a loss situation. So then you've got to contemplate that too, and how that might work from a business point of view. If you've got to say, I gave that laser machine example, if it's a $2 million laser machine, but your profit's only $1 million for the year, that's going to create a loss of $1 million. So what we do as accountants is we review whether it's prudent to actually claim that deduction or use the other capital allowance rules available to us to work out whether it's a good thing to claim that to push you into loss or not. And then there's also some other rules that the government announced last budget, which is what's called loss carryback rules, which also you have some consideration you need to consider as well. So it's quite complex, but definitely is a really attractive option. And as I said, as Peter mentioned before, 9,000 is what you get for motor vehicles. Also, if you're being pooling, so there's small business pool, there's also the ability to write off a pool if your turnover is under $10 million. So I'm not going to go into all the details because we're here forever on it, but it's quite complicated. Yes, Chelsea.
George is just wondering, does it need to be paid in cash or can it be leased or rented in order to be claimable?
Okay, it's got to be deemed to be purchased, which means it has to be financed either through a chattel mortgage or a hire purchase contract. If it's an operating lease where you don't take ownership until the end of the lease, the answer is no. And if it's a rental agreement where basically if you stop the rental, you hand back the asset, the answer is no.
Does the asset have to be physical or can it be software?
Physical.
So
Yes.
computer software
no.
is not relevant.
No, it's not. That's not one of the eligible assets.
But a computer would be because it's tangible.
Yes, correct. Yes. Buildings is not one you can claim either. So there's certain exemptions, but yeah, by and large, it's equipment that's depreciable in value, but it's got to be physical, tangible assets. Yeah.
Right.
So trademarks and things like that as well. No, it's got to be a physical asset. So a really good one. Just quickly on FBT, because I mentioned it before. The FBT rate, we try and avoid FBT as much as possible by doing other things, but 47%, it's a horrendous tax. So part of what we do as planning is we make sure that we try and minimise FBT as much as we can. And one of the key things for that is, and motor vehicles is the prime example of this, is making sure you can maximise the deductions you can claim for the expenses that might be subject to FBT. Fringe benefits tax relates to assets where there might be a private element to that asset. So example is a car. So driving to and from work is not a business trip, that's a private trip. So if you're trying to claim motor vehicle expenses for your business, you need to understand that that's a private trip and therefore that will then potentially trigger a fringe benefits tax liability. So the way we look at these things is one must do a logbook, really critical. 12-week logbook. We're probably too late for the current financial year if we're doing it now. But a 12-week logbook is what's required to try and establish what that business usage is. And that generally gives us the best option in terms of trying to minimise FBT. If you don't do a logbook, then the way we do it is we do what's called the statutory fraction method. And it's very simple these days. They take the value of the car and multiply it by 20%. So again, that Aston Martin Peter that you bought, 250,000. The private usage, deemed private usage of that in year one is just on depreciation, 20% is 50,000. So you looked at, you got $59,000 tax deduction. Now you're giving back 50,000 this year, potentially in FBT consequences. And then each year after, you've still got that same issue to deal with. So that's why you've got to be very careful about how you structure assets, and particularly motor vehicles if they're luxury cars, because the consequences of trying to get the tax deduction up front may be adverse to you in terms of ongoing fringe benefits tax. There's been some relief based on COVID-19 where they've given some exemptions from FBT that otherwise weren't there. So key ones is if you had to relocate an employee with flights back to Australia, they're not going to charge if you as a business had to pay for that. Normally that would be a private expense and be subject to FBT, but they're actually giving exemptions on that. Food and temporary accommodation due to restrictions. Self-isolation and quarantining expenses. So one of the ones is, they will if you're giving, having to pay for them to stay in a hotel for some reason to quarantine, they're normally paying for accommodation for an employee if it's not related to a business trip or otherwise would be subject to FBT. They're given an exemption for that. So there's a few exemptions that have been in place for COVID-19, but they will be finishing, I can't remember, I forgot to check that date. I can't remember the date. I've got a feeling it might be 31st of March 2022, but don't hold me to it. Because FBT works on the 31 March balance date each year, unlike tax, which works on the 30 June balance date. Now, just on franking credits, back to that dividend scenario, or back to the company tax rate and everything, and I just thought I'd quickly go through how franking credits work, because it's a complicated matter, and I'm just going to go this really quickly. But you get a dividend from, and this is relevant in terms of tax planning as well, because the franking credits are linked to the company tax rate for your business. So if you're on a 30% tax rate, then the franking credits will flow through at 30%. If you're on a 27.5% tax rate, then the business will, which is the current year's tax rate, then the franking credits will flow through at 27.5%. With the tax rates coming down to 26 now, so that was last year, 26 now down to 25. That will change the franking credits attached to franking credits. And just on that, interesting enough too, so these lovely discussions from the government about dropping the income tax rate in companies from 30 down to 27.5, down to 26, down to 25. If that money ultimately comes out to an individual, it's exactly the same tax, because they'll pay top-up tax because they get less of a franking credit, which means if their marginal tax rate is the same as what it was 5 years ago, instead of getting a 30% credit against that tax rate of 47%, they're only getting 25%. So they pay the additional tax. So it's a little bit of, it's a timing issue, but a bit of smoke and mirrors from the government as well. So that's why they've been quite willing and comfortable about reducing the company tax rate, because they know that ultimately, as those dividends come out, they're going to get that back from the taxpayer. The only exception to that would be those who are getting refunds of franking credits, which I'll go through in a minute, which is potentially super funds and low income earners. So franking accounts, basically the way it works, franking credits are when you pay a dividend from a business. If you've paid company tax in your business and then you declare a dividend out to the shareholders, then that dividend will be what we call a fully franked dividend if there's enough tax paid on that dividend at the company tax rate. And it's complicated in how it works, and the best way to go through, cutting through all this, is to give you some live examples, which I'll do in the next screen. But there's a bit of a formula of how it gets worked out, but I'm not going to go into that in detail. I'll show you on the next screen a live example, and then everyone will get notes from today's session as well, so you'll actually be able to work through that, and then you can talk about it with your Aintree group account or whoever it might be in further detail. But let's go through an example, because this is, I think, a much clearer way to describe it. So let's say that your company is paying tax at 30%, and you decide to pay a dividend of $100 out to your shareholder, and your shareholder is an individual. So the dividend paid is $100. And what I've done here, I've got different tax brackets. So this is based on your marginal tax rate. So if you're on the zero marginal tax rate, that's then 19%, 34.5, 39, and 47. We'll go through that in a couple of slides later about what the tax rates are for individuals. But let's say it's the same dividend going out to each of those different people in that scenario. We have to add onto that the franking credit for that dividend. Now, just go back quickly. The way we work out that franking credit here is we need to work out what the dividend would have been. We need to gross up, in effect, the dividend to what the pre-tax liability would have been on that dividend. So I'll try to explain it this way. If you've got a company that made $100 in profit, you pay tax at 30%, then your net retained profits in your business is $70. And then you declare a dividend for $70, then that goes to the shareholder. What the rules are is they want you to gross that back up to what the pre-tax profit was for the company. So you're declaring the same amount as what the company paid before they paid tax. Now you might think that's unfair, that's double taxation, but that's how the franking credits work, where they give you then a credit against that. So to give you this example again, so if and I maybe should have done this on a $70 basis, but if they made a $100,000 distribution to their shareholders, then the franking credits will be $42,857. And what that is that's basically this silly formula to basically gross it up to what the original profit was that the business made before it paid tax at 30%. And so if I had a profit of $142,857 and I paid my tax at $42,857, I'd be left with retained profits of $100,000, which is what the dividend is that goes out to the shareholder. So then, as I said, the $100 goes out. We then have to gross it back up to that franking credit. So the taxable income or taxable value that the shareholder shows in their tax return is $142. So we're grossing it back up to that pre-tax profit of the company. But then we get a franking credit for that gross up. So we gross it up and then we get a franking credit for it, which means that then we then got to apply our marginal tax rate. So in this case, because I'm on a 0% tax rate, my marginal tax rate is 0. But then I get a credit for the $42.86 franking credit. I will actually get a refund of that $42.86. And so therefore my net cash position as a shareholder is $100 that I received originally from the dividend, and then an extra $42. So I've put in my pocket $142. And that's how it works for a person on a 0% tax rate. Now, a little bit of commentary on that quickly. The issue it's very generous, and the Labor government was looking at abolishing that refund of franking credits in the last election. They got hammered and they didn't get it through. I'm not going to say too much, except I think something like this needs to be looked at, because let's say BHP paid $3 billion in tax and every single one of their shareholders was on 0% tax rate. So therefore the government collects $3 billion in tax from BHP and then they give $3 billion back to all the shareholders. So what revenue has the government collected? 0. So it's very generous. And this is where a lot of people on 0% tax rates are generally self-funded retirees or pensioners with superannuation balances. So they're the ones that were affected the most, but and that's the reason why they were affected the most, because they were going to lose potentially that extra $42. So 42% of that income that they generated from the dividend, they're going to lose that because of the Labor government, or Labor proposed to abolish the refund of franking credits. Let's go to 19% and quickly down the bottom. So tax rate on 142, 19% is $27. Less than 42, you're still getting a refund. So you in front $115, 17. So your return on investment, you put in, so you basically put in $100, you get $100 return as a dividend, and then you get another 15% of that as a refund of franking credits. So a good return on investment. 34.5%. Now that's higher than the company tax rate. So this is where we now start to pay. So $49 is tax payable, and that's a refund. So you net out of pocket $6.43. This is what we call top-up tax. You're paying the additional tax because your marginal tax rate is higher than what the dividend franking amount is. So you're out of pocket, so therefore your net return is 93, 39%, 87, 47%, down to 75. So you can see the difference between here and here is quite dramatic. So what I'm getting at with all this, one, to show how it works very quickly, not simply, but quickly. Secondly, dividend strategies in terms of our clients is very important too. So looking at timing of when we declare dividends, because as I've done in this illustration, the tax rate here is 30%, but as the tax rate comes down, these numbers are going to change. So instead of getting a franking credit of 42, if the tax rate's only 25, that's going to be less, and therefore you're going to get less return or refund from that. So we look at dividend strategies in the context of changing tax rates and how that might apply to clients. So again, if you're looking at taking some money out of the business or otherwise, it might be a worthwhile strategy to look at bringing forward a dividend for your company to get the franking credits at a higher rate, potentially. It just comes down to your circumstances. But really, and then just to give you an example, superannuation funds, accumulation, they tax 15%, net refund on $100 diff or net cash position, $100 is $121. If you're in the pension phase and we've got a 0% tax rate, then back to that $142. So again, if BHP is owned entirely by superannuation funds, most of that tax is going to be refunded because we've got tax at 30% and we're giving back 15% of it in effect here and we're giving back 30% of it here. So it's really interesting how that works. Any questions on that? Probably a bit overwhelming. Now, tax rates, and this is why we were talking about tax rates before, and this gives you the context of the 0, 19%, 32.5 plus Medicare, 37 plus Medicare, and 45 plus Medicare. Change in tax rates. So this is something that the government brought forward when COVID hit, but these are the current, so 2017-18, these were the tax brackets. So 0% up to 18,200, 19% to 37, 37 to 87, 180, 180 plus. 2018 and 19-20 financial years, they changed that 87 up to 90, but pretty much everything else stayed the same. Then they brought forward the first round of the tax cuts they were proposing. So what we've got here is that's gone from, that stayed the same, but that's gone up to 45,000 threshold where the 19% bracket applies. And then 40, instead of 90 for that bracket to finish, now that's gone up to 120. And then that bracket has gone from 120 to 180, and then 180 plus is still the same. And then all things going to plan with the government at the moment, this is what they're proposing from financial year end at 30 June 2025 onwards. Leaving that bracket there, 45 will stay, but then we've got this massive new big bracket, 45 to 200,000 at 30%. And then 200 plus is at 45 plus 2% Medicare.
Medicare only 2%.
Yeah, if you've got surcharge and things like that, there might be additional private health insurance issues, but yeah. So key thing with this, what I want to highlight is if we've got large companies paying tax at 30%, we've got shareholders and individuals paying tax at 30%, then dividends are going to be very tax neutral coming out if you're on that bracket. And it's a fairly big bracket. It's quite a substantial change from where we were back here. And then we go way back. It was actually, I can't remember, I was looking at some records from back in the 80s or something. I think the effective tax rate was over 50,000 or 66% or something at one point. It was horrendous. So we've come a long way from there. But the reason they're doing this is because we're supposedly not, we're not competitive in international terms. And we're trying to be more competitive in that point of view. And also wanting, hopefully, people have more money in their pockets so they can spend. Whether it's effective or not is another thing, but that's what we're looking at. So again, from us as accountants, this presents some tax planning opportunities for us in terms of dividend strategies and other things, because those rates, now I know it's a couple of years, few years away, but it's definitely a big change in what we've got at the moment. Oh, sorry, yes, I keep wandering over, apologies.
What happened between 2021 and 22? You've got up to 20 to 21, and then you say, and then 2. So is it still part of that bracket?
Yeah, correct. So that's going to, where's my buzzer
So
gone?
it goes from 20 to 24?
Yeah, so that goes from there to there, so and then from 24 onwards. So yeah, so we've got, so for the next 3 years, we're in that
This bracket, yes.
this bracket, yeah. But yeah, that's quite interesting. And now, again, Labor have said that they might not support that. We're just got to see what the political dynamic is to see whether that gets through or not. But that's quite a big change. Okay. So tax-paid Australians for the individuals, same thing as what we talked about before. So before 30 June, and a lot of these require cash. So if you've got a term deposit maturing, it's probably too late now because you've already locked it in, but you should not try and have anything mature before 30 June and defer it to the next financial if you can. That pushes out the tax liability to the next year. This one's really important, capital losses. So if you've already got capital gains in the year, you sold a property or otherwise, and then you might have some capital losses on some shares or something like that, it might be worth considering selling those shares to crystallise a capital loss so you can offset that against the capital gain to try and reduce the tax liability on that capital gain. Similarly, if you've got a capital loss, you can carry forward that indefinitely, but you might think, look, my circumstance is going to change from 1 year to the next. It might be worth looking at selling one of the assets I'm thinking of to get the benefits of those capital losses in the current year. Now, a key thing with selling assets is it's the contract, generally it's the contract date, not the settlement date. So and that's one thing really important for property that a lot of people don't remember or don't know, is that, for instance, if you're looking at selling a property and you sign a contract on the 30th of June, then that comes into the current financial year, even though settlement might happen 3 months later. Similarly, if you defer it to 1 July, the contract signing date, then that pushes it into the next financial year. So really, it's important to understand that it's the contract date generally for selling assets, which dictates which financial year that gain or that loss comes into. Right? Not settlement date. A lot of people have this misconception of settlement date. That's not the case. Settlement date applies to GST generally, but not for capital gains tax. And so again, if you think you're going to be in a different bracket from 1 year to the next, you might be looking at retiring or winding down or working part-time, then again, think about the consequence of doing something before 30 June and after. It might be better to push something into the next financial year where your income is lower because you'll get a better tax outcome. Obviously, you don't want to, again, do things just purely to get a tax benefit because the markets might be such that it's the right time to sell something today. If you hold out until 1 July, I'll mention cheekily cryptocurrency might be something like that, where it's very volatile. But just bear in mind that you don't do things just for tax liability because that might then have an impact on the market value of that asset. So shares is a particularly good example of that, where the market can change quite dramatically. Also donations. So if you're looking at making donations, look at the years of timing when you do that. So if you're someone who's really who likes to give donations regularly each year, just look at the timing of that in context of income. And also the other thing with donations too, make sure it is actually tax deductible. We see a lot of donations where people make large contributions to organisations where they're not what's called a deductible gift recipient, and therefore you can't actually claim the tax deduction for it. So if you want to get that tax deduction, make sure you do your homework beforehand. Generally, it says donations more than $2 are tax deductible on the receipt, but sometimes it might be a sporting club or things like that where you make the donation, it won't be tax deductible. So just be very aware of that. Similarly, donations overseas, unless it's a registered deductible gift recipient charity in Australia that does then provide World Vision's example, that's fine because they help people overseas. But if you're sending money straight to an overseas charity, they will generally not be that will generally not be deductible to you. So just be careful of that. Rental property deductions. It used to be that you go and travel to your Queensland rental property every year and do an inspection and make sure it's all okay and claim that as a tax deduction. It's gone now. Can't do it anymore. So that's gone. And you could also get away with it twice a year, but no, you can't do that anymore. And then this one's really important for rental properties too, and they changed rules a couple of years ago. So if you bought a property, let's say it's an apartment that's a second-hand, so someone else, you bought it from someone else, it wasn't off the plan. You used to be able to get what's called a depreciation report or a quantity surveyor's report for that property, and therefore claim the deductions on the depreciation on that property. You can't do that anymore unless you're the one that physically purchased it from the builder, or you've made additional purchases of assets within that property yourself. If it's coming from someone else, so they put in a new kitchen a few years ago, or they added a new room or whatever, and you can claim depreciation, that's all gone now. You can't claim those tax deductions. So they've tightened that up. The key thing with personal deductions, another one you can look at doing, which is really effective. If you've got an investment property, you've got interest on that property, and we're doing this with a client at the moment, fix the interest rate on it and look at prepaying your interest for 12 months. You'll get a tax deduction for that. So that's something you can do. So that's an effective strategy. Superannuation, which we'll come to in a minute, is another effective strategy. So common deductions, just be mindful of home office expense. So obviously a lot of people worked at home during lockdown, so we can claim deductions for that. 80 cents per hour, 80 cents per hour is what you can, no, sorry, I've got that wrong. Sorry, Ash, what is per 80 cents per hour? Yeah, it is per hour, sorry, yes, per hour. That's available up until 30th June 2021. You still need to substantiate it with diary records to show that you're actually doing the time. And we had a review from a client, and they asked for diary records and everything to substantiate that they were actually doing the work at their home. So you've got to be very careful with that. And motor vehicle expenses, make sure you keep all your receipts for motor vehicle expenses. Logbooks, as we talked about before, really important. But receipts, ATO likes motor vehicles, easy target. You've got the rental, you've got the repairs and maintenance receipt. Make sure the odometer ready on that ties in with the logbook as well. We got to be careful of that, because they will check the receipts to make sure they are legitimate as well. And then uniforms. So if you've got to pay for a uniform to work it wherever you might be working, claim that laundry expenses. But again, substantiation is required. We can't just say blanket, you can claim $150 or $300 for this. You do need to provide substantiation for it. And union fees, self-education costs, and there were some changes in the budget regarding self-education. There used to be a $250 cap before you could claim anything. They're removing that coming forward. Publications, etc. that you can claim. But the main ones is really motor vehicle, home office, and then computers, equipment, things like that, laptops, etc., which can be claimed. Just for low income earners, there's also some spousal contributions you can take advantage of if you've got low income within the family. This one, just quickly, high income earners, there's this Division 293 tax. What that means is when you make a super contribution, normally you get taxed at 15%. If your what they call adjusted taxable income is more than 250,000, they charge you additional superannuation contributions tax. So instead of being 15, it could be up to 30%. So that's just something to be aware of. So again, tax planning around that's really important. If your income's going to be close to that threshold, you're looking at making super contributions. We need you to be aware of that Division 293 tax, and we try and avoid it. And the key thing with that too is if your income is 249,999, it's zero contribute tax. But once it goes over 250, it is 15% on the contributions. So it's a flat tax.
Phasing.
Yeah, no phasing at all. So it has a major impact. Capital gains. So foreign residents. So this one, people are probably aware where they've sold a property now. That you need to make sure that you're an Australian resident for tax purposes when you sell a property. So if the property is worth more than 750,000, and this is a great one from the ATO, they deem you to be a non-resident unless you apply to them to be deemed to be a resident for tax purposes for this thing. So you can't just say, I've lived in Australia all my life, therefore I'm an Australian tax resident for this one. The answer is they don't care. So if you sell a property, now your lawyer or conveyancer will help you with this anyway, and we will fill out the form, and the ATO is very quick at getting back. But basically, before settlement, you need to have that certificate saying that you're an Australian resident for this purpose. Otherwise, they're going to withhold an additional 12.5% from this. They're going to withhold 12.5% from the sale price. Right? So that's on a threshold of 750,000. Also, if you're a non-resident, you don't no longer get the capital gains tax exemption for your principal residence in Australia. You don't have one. There's no such thing anymore. So if you're a resident, if you're a non-resident, you're here for it temporarily, but you buy a property to be your principal residence, and then you sell it when you leave or whatever the case may be, then you've got a capital gains tax you need to deal with on that. And then secondly, you don't get a 50% discount either. So that's something else to be aware of. And then I'll just mention the cryptocurrency because it's very topical at the moment. Just be very aware of the tax consequences of cryptocurrency because people think, oh, it's cryptocurrency, I don't have to pay tax on it. That's not true. It's actually deemed not to be cash. It's deemed to be an asset for capital gains tax purposes. So yeah, don't think that I've just got crypto and it's gone up in value and then I move it from here to there or otherwise, and therefore it's no issue because it's deemed to be cash. Incorrect. Tax office, there's a tax ruling on it saying that it is deemed to be an asset for capital gains tax purposes. So just need to be very conscious of that. A lot of people are bought it in their own name because they were doubling in it, and then the market's gone, and now they've got some tax problems they need to deal with in the future. So we're not going to go into any more detail because we spend all night on crypto as well. Superannuation. Okay, so superannuation funds, when it's in accumulation phase, so when you haven't retired, tax rate is 15%. Pretty clear cut. Capital gains tax, it's 10%. Sorry, thank you, Chelsea. Keeps telling me to move over. So for capital gains tax, it's, if you've held the asset for more than 12 months, it's actually 10%. So they give you a 1/3 discount on the tax rate for super funds. So if you've got a property in super fund and you sell it, then you pay tax of 10% on it if you're in accumulation phase. Now, the cap. So we can put, a person can put up to $25,000 per year into superannuation and claim a tax deduction for it. So give you an example. I'm working for Aintree Group. I'm on a salary of $100,000, and therefore this Aintree Group pays me $9,500 worth of superannuation into my superannuation fund. If I so choose, excuse me, if I so choose, I can put further amounts in. I can do it through salary sacrifice. I can put another roughly $15,500 in through my employer, or I can make my own personal contribution into super to bring that up to $25,000 for the year. So I've got that threshold of $25,000 per year. So it's a really good tax planning strategy, because back to the slide before, if you're on the top marginal tax rate, so if I'm on 100,000 as an example, my tax rate at that level is 31%, including Medicare levy. If I make that contribution into super, I get a tax deduction for 25 off my 39% tax rate, and then the super fund pays 15. So the difference between the 39 and the 15 is 24%. So I'm getting a tax benefit of 24% on that 25,000 I'm putting in. So I see that as a return on investment, which is good. So it's worth considering if you can do it. Now, it requires cash. In addition to that, if you decide to put non-deductibles or what we call after-tax contributions or non-concessional contributions in, you can do up to $100,000 per year of those. You won't get a tax benefit for it, but it's a good way to get excess cash within superannuation, where the tax rate is either 15% when you're in accumulation and potentially much lower when you're in pension phase. So again, if you've got excess cash and you don't have any investments you want to do through outside of super, and you're not fussed about that being locked away in super potentially to the age of 65, then you can put that money into super. And there's also a bring forward rule that if you're under 65, you can actually, that 100,000 multiply by 3, and you can do a bring forward rule and do 3 years worth of contributions in one go. So if I'm at 30, getting close to 30 June now, and I want to put 300,000 in now instead of the 100,000, I can do that. But then it stops me from making contributions for the next 2 years, because I'm bringing forward the next 2 years' contributions. So something we do in terms of tax money for clients in that respect, and you're getting close to 30 June, is what we could do is we put $100,000 in this year, and if I've got more than the 300 I want to put in, and then on 1 July next year, or 1 July next financial year, I put another 300,000 in, I get in 400,000. So I can get more in that way. And also the rates change from 1 July 2021 as well. And I'll come to that in a minute. So getting money to super, low tax environment, 15% versus marginal tax rate. At company level, it's 25% potentially for you, or 30%, and then also marginal tax rates personally, it could be up to 47% marginal tax rate. One thing really important for businesses, from 1 July, the superannuation guarantee, 9.5% you have to pay on employees, goes up to 10%. So that's something to be aware of. So you need to check your contracts to see what your contracts say, but it might mean that you've got an additional cost in your business because you have to make that additional superannuation contribution for your employees from 1 July. It comes down to whether your contracts with your employees are inclusive of superannuation. So you've got a remuneration package inclusive of super, or this is my salary plus superannuation. So in theory, if it's including superannuation, what they get it in effect a pay cut in their cash, and then you put more into super for them. So they get the overall same amount, but they get less in their pocket and more goes into super. If it's plus superannuation, then they get an extra 0.5% superannuation going to their fund, and their salary remains the same. So just look at that, work out what you want to do with your business, whether you want to just pass it on or absorb that cost or whatever it might be. But that's something just to be really aware of. So check your contracts with the employees to work out which applies to you and your business. Good tax planning strategy. Before 30 June each year, try and pay any superannuation liability you have for your employees. So, if you're doing your pay runs, generally you've only got a quarterly obligation with superannuation. So you only need to pay it 28 days after the end of each quarter. So in theory, the June quarter for 2021 is not required to be paid until the 28th of July, 2021. But you can bring that forward to before 30 June and then you'll get a tax deduction for it this current financial year, because superannuation is only deductible when paid. It's actually technically only deductible when the superannuation fund receives the money for the employee. So you might write the cheque, or you might do the EFT on the 29th of June, but if that's not received by the super fund by 30 June, then that's not tax deductible this financial year. So what we say in this, and that's why we've got on here very clearly, we recommend that if you're going to look at paying superannuation for the quarter ended June, before 30 June, you do it no later than the 22nd of June. Now that might cause some complications in terms of when your pay runs are, but if you can do that by that date, then you're guaranteed to know that that money will be into the fund by 30 June. We had a client last year where they paid it on the 24th of June and it didn't go in. And so they therefore, and then what happened is then they had a review from the HO, because we assumed it went in because we thought 6 days is enough. Then they had a review from the HO, and the HO confirmed they didn't hit their accounts of the employees until 1 July, and therefore it was non-deductible. So it's really important.
Can't be held responsible for that.
You can try, but good luck.
And in relation to the fact that the financial year concludes after the date that you're saying to get it in, you pay up until the end of May.
Yes, that's what you could do.
And then we pay the remaining
Yeah,
month.
correct. Yeah, so you just do whatever you can, and then if you haven't got pay runs up that, you just leave it, and you just have to forgo that benefit. But that's a good one to get the tax deduction this year. If you don't do it by the 30th of June, by the 22nd of June, it goes in by 30 June. You do it the next one, you'll get the deduction next year, but this is a good way to bring forward an expense that you're going to incur anyway. And that's the thing with tax planning too. What I say to a lot of clients is that tax planning, some of them might be just deferrals, but if it's something you're going to pay in July or August anyway, it doesn't hurt to look at bringing that forward if you've got the cash flow to be able to do it, to be able to get the benefit this year, because that gives you then 12 months of a tax benefit before you then might have to pay the tax on that deferral that you've got anyway. So it just means you've got more potential working capital within the business or otherwise to be able to then do other things to try and get a better return on that than have to pay to the tax office and dead money. So yeah, clearinghouse, really important that you make sure that it's a bond, so you've got to make sure you do that voluntarily in advance. And also too, if you've got employees who haven't given you a superannuation funds that they want you to contribute to under the choice of super provisions, then you must have a default fund which you can put the money into, and you need to put the money into that default fund. So again, we see sometimes where a client says, oh look, they didn't give me their superannuation details, so I've just not paid it, just not paid the super. And it might be 6 months gone and they haven't paid the super. That's not good enough. You should have a default fund, and you just put that money into that default fund. It might be, you know, whatever Australian super, whoever it might be. I'm not recommending that to put into Australian super, but because I'm not allowed to. But yeah, whatever it might be, you've got to have that default fund. So if you've got a situation where you don't get the details from the employee in time, you can put it just into that fund. They can then, once they give you the details, transfer that to whatever fund they nominate. Personal contributions. So deductions for personal contributions. So as I said before, if I have an employer who pays me 9.5%, so 9,500 on the 100,000 salary, and I want to make additional contributions, I can do that as a personal contribution, and I claim that in my personal tax return. I have to meet some certain tests. So I've got to meet this work test if I'm over age 65, but if I'm under the age of 65, there's no tests I need to meet. And the government is proposing to make some changes to the work test, but not in relation to personal deductible contributions. They're talking about that for the non-concessional or non-deductible contributions. But yeah, you need to make your work test. And then this is really critical, and the ATO is really cracking down on these now, that if you make that contribution into the fund, you need to then fill out a form and send that to the superannuation fund to say you're intending to claim a tax deduction for that amount you've contributed. If you don't do that, and we lodge a tax return with that deduction in your tax return, the ATO will knock it back. Because they're saying you haven't filled out this form to say you're going to claim a tax deduction for it, therefore it's non-deductible.
Oh.
Yes. So getting really strict on it. So really important. So what you need to do is when you make that contribution to the fund, they will either one, send you a form because they see the contribution coming in, they'll ask you how to nominate for it, or two, you've got to ring them and ask them for that form so you can fill it out, or there's a form online you can complete and then send that to them. But generally you should ring the super fund, ask them for their templated form, fill that out, send it back to them, and try and do that within 28 days after the end of the financial year, so it's in the system and recorded. So again, we've had situations where we've claimed that and lodged tax returns for clients before the 28th of July, because it's not on the ATO system. They then come back to us and inquire about whether that's actually deductible or not, because they don't have records of that intention to claim for. So really important you have that form completed. So we're being very diligent on that now, and if we're claiming a tax deduction for a client in their personal return, we do not lodge their tax return until we've got that form.
as an employee, do we have to advise our, around my staff to do that?
No, if that's something for if they make personal contributions, that's their responsibility to look after that. Yeah, so not business one. So this is just if they make it personal. So the 9.5% or the 10% from 1 July that you make, there's no obligation to report that in any way, because that's just through the normal employment processes and single touch payroll. But if this is an additional contribution that's personal and they want to claim a tax deduction for it, they need to go through this process. Yeah. Retirees. So just there's used to be this thing, or there's this legislation called transition to retirement, where you can actually start a pension and withdraw money out of your super fund while you're still working. They changed the rules a couple of years ago in 2017 to say originally it used to be once you started transition to retirement pension, the super fund tax rate changed from 15% down to 0. They've now reverted that back to 15%. It was becoming too popular and they're losing too much revenue out of it. But when you're in retirement, when you pull a pension payment out of your super fund, that is tax free. So you don't have to declare that as income unless you're still in the transition phase. But if you have retired and you've done everything to say that you're retired, then any money you withdraw out of the super fund will be tax free. While you're alive, there's some issues when you're dead and some tax consequences for the family. But I'm not going to go into that today. That's, again, can be another session.
We have a question from the
yes.
Zoom. Does the intention to claim form apply for self-managed super funds?
Yes, it does.
Yes, it does.
So do you automatically do that?
Yes, we do. Yeah. So when we do, if we're looking after your self-managed fund, we'll do that as part of our year-end process.
I can't remember.
No, you've signed one, and yes, it is on file. So yes.
Well done.
Yeah.
There's another situation when we've got the 10% the increases from the 1st of July. My understanding is the capping of $450 earning is ceasing. But
yeah, I'll cover that in the budget. Not from 1 July. It's later.
The following year.
Yeah, correct. Yes, but I'll cover that. You spot on, but I'll cover that. Yes. Low income, again, we talked about this briefly before. You can actually make contributions, get a rebate if you've got low income within your family and you make contributions for your spouse. That's an option for you to look at. I'm not going to go into much more. I mean, we've talked about Division 93 before as well. So just to show you the caps, so they are changing. So as I said before, $25,000 concessional contribution cap and $100,000 non-concessional, non-deductible, and then the bring forward rule 320. From 1 July, they change. So from 1 July, the concessional contribution cap goes up to 27,500, the non-concessional up to 110, and the bring forward rule brings it up to 330,000. So again, some opportunities there and a bit more than going to super. They do this based on the average weekly ordinary time earnings thingamajig and rah. It's so this has been in place since, I think it's taken about 4 years for them to get to the next threshold where it goes up to 27.5. They only do it in $2,500 increments. So the next time this changes, which could be in 3 or 4 or 5 years, with wages being fairly stagnant, it might be 5 or 6 or 7 years, who knows? But the next increase in that will go from 27.5 to 30,000, but we don't know when that will be. But that's what they are available from 1 July. So again, a bit better of a tax benefit if you can take advantage of it.
But then there's a cap if you have balances over.
Okay, so on that one, there's no cap. If as long as you're under 75 and meet the work test, you can put. So if you're under 65, there's no. That's 27.5. There's no restriction on that whatsoever.
If you're over 65.
If you're over 65, between age 65 to 74, you need to satisfy a work test, which is you must work 40 hours in a 30-day period in 1 month during the year. Then if you tick that box, then you can make a contribution in that month or any subsequent month. So you've got to meet that criteria first, and then you can put 25,000 in or 27.5. If you're over 75, the answer is no, you can't.
But what happens if member balances over
$1.6 million cap applies to this one.
The 110.
The 110 doesn't apply to that one, right? So yeah, and I'll cover that in a minute actually. So that's called the transfer balance cap, and that does put restrictions on what you can put in after-tax contributions. And again, they're trying to stop people who've got sizable super balances putting more money into a low tax environment. They prefer you to have it outside of super where you might pay a high tax rate on the investment returns. Oops, sorry, I'll just skip something. So the last thing on this one, which is a new thing that's only been in the last couple of years, is what's called the carry forward of unused concessional contribution rule. Now, what does that mean? It basically means that if your member balance is less than 500,000, and let's say we talk about this $25,000 cap, let's say in the 2020 financial year, you only put $10,000 into super, including your employer contributions. What they allow you to do is do a catch up of the cap that you missed. And I'll show you an example on this. This is a live example on the next page, so you get an understanding about how that works. So this is a client situation where we're talking about the 2021 financial year, and the cap for the 2 years is 25,000 per year, which is 50,000 for the 2020 year and the 2021 financial year. And this person has put in so far between those 2 years 34,000. They allow you to do a catch up because the member balance is below 500,000 of an additional 15,000. So you can put $50,000. So if I only put $10,000 in last year, I can put $40,000 in this year and still claim a tax deduction for it. So, provided that I'm only claiming the maximum 50,000 between the 2 years. So they allow you, if your member balance is below 500,000, to do a catch up under this carry forward concessional contribution rule. And this is a live example of a client where that's what they can still put into this year to get a further tax benefit. Right? So that's a good one if your member balance is below 500,000, encouraging people to try and top up their super so they become less dependent on government pensions and so on when they retire. And then this is a bring forward rule we talked about with the contribution caps and everything. So just again, summarising this. So we've got this limit that we have to take into consideration, the bring forward rule. So that 330,000 applies if you have a member balance cap below $1.6 million up until 30 June 2020. But the current financial year has gone up to 1.7. And I'm not going to go through all this. I'm going to say this very bluntly. The government complicates things unnecessarily. If you've got a member balance between these figures, you have to do this silly calculation to work out what your member balance cap is between 1.6 and 1.7 million. Instead of just saying everyone can get a 1.7 million cap from 1 July up to from 30 June 2021, you have to do this silly formula to work out what it is. I'm not going to go into that detail, but what it shows is these are caps because it affects the bring forward rule about how much you can bring forward. So how your member balance is between those figures, you can only do 100,000 because they don't want you to exceed the $1.6 million cap. In this scenario, you can only do 200,000 because they don't want you to exceed the $1.6 million cap because they're using 1.4 as a baseline. But if you're less than $1.4 million balance, because after you make the contribution, in theory, you're going to be, it's just, I think it's madness. And then after 30 June or this year, we've got these silly numbers that we have to deal with to work out what we can do as carry forward caps. Long and short of it is, if you're looking at making lump sum contributions doing bring forward rules at all, one, we need to check your member balance to make sure you fit within the criteria, but two, you need to get advice from us so we do the proper calculation to work out what you can and can't do. But a lot of unnecessary mucking around when they could have made it far simpler, and that's just confirmed that again. So it's being moved from 1.6 to 1.7. So every member in a fund, thank you, every member in the fund, so the deal is that when you start a pension, you can only start a pension to the value of 1.6 million, going now up to 1.7 million. The balance of your member balance above that is taxed, treated as accumulation account and is taxed at 15%. So it does affect what you can put into pension phase, and also can affect, again, if you pass away or a family member pass away and they've got a balance above that $1.6 million, it complicates things in terms of tax on the way of dealing with the estate and how you deal with the member balance above that threshold. So it's really, it's made things far more complicated. Now, just general strategies quickly. Just to do with residency and so on. So if you're moving to or from Australia, you need to talk to us because residency for tax purposes is really complicated. In fact, they've released finally, they did a review of residency status. It's all common law residency. So it's not just saying, okay, yes, you meet this test, you meet this test, therefore tick you're a resident or a non-resident. You have to look at all these common law issues. You have to look at where you domicile, where your children are, where your assets are, what your intentions are, all these different things to work out whether you're an Australian resident or not. They did a review of this back in 2017. They finally released a report just today in terms of the findings and what they're looking at doing with this, that they're actually looking at trying to simplify it in some way. But they haven't come up with an idea of how they're going to simplify it. They've just given motherhood statements about we're going to look at this and this and this, but they're going to try and simplify it because this is an area that's very grey and is subject to a lot of court disputes between the ATO and taxpayers. So if you're looking at moving overseas, or probably a bit difficult to move overseas at the moment, but if you're looking at doing that at some point for an extended period of time, you need to get advice from us because it can have an impact on for capital gains tax purposes with assets you hold and other things as well. other housekeeping. So if you have trusts, you need to make sure that we're doing appropriate documentation each year. So each year we need to do what we call a distribution resolution for the trust, which stipulates how we're going to allocate the profits for that year. We need to make sure we do those on a timely basis. We do those for our clients. Also, if you've got large franking credits, dividends we talked about before, franking credits going through your trust, we need to make sure that we're reviewing the tax consequence of that, because there's what we call family trust election issues we need to deal with, where you might not be able to pass on those franking credits down to the beneficiaries if you don't do certain things from the tax under the Tax Act. Again, we look at that for you when we're doing your year-end tax returns, etc. Be sceptical of tax shelter schemes or tax minimisation schemes. Generally, if they're too good to be true, they're too good to be true. So just be mindful, and you'll get emails, you'll get lots of things, scams. There's so many scams out there these days. But if someone's going to promise you a return that's 30, 40, 50, 60%, then be very aware of it. And again, talk to us first, and we can tell you whether it's a legitimate scheme or not. If someone's pushing a product to you where you invest in something, they should have what's called an Australian Financial Services Licence. So they should have an AFSL. And if they don't, then that's a first warning sign if they're trying to market a product to you to invest in that gives you a tax benefit or some mega return. So if you're not sure, let us know. We can then do the research on it very simply, because there's a register of AFSL holders where we can find out whether they're a legitimate business or not. But there's lots of people out there trying to take advantage of you. So really be careful about where you put your money. Seek our advice first. And look at capital gains. So capital gains get concessional tax. So look at the timing. So if you hold an asset for more than 12 months, you get a 50% discount for capital gains tax purposes. If you hold it in your personal name or through a trust. If it's in a company, you don't get that discount. So there's some differences in the treatment per structure. So just to be mindful of that. But make sure that, if you're looking at selling an asset you've held for 11 months, do you look at deferring it for 12 months? Date of contract, again, really important. Date of purchase is date of contract. Date of sale is date of contract. So look at that time frame and work out whether you're within that 12-month period or not. So that's really important. And look at what might be concessionally tax-free fringe benefits for tax purposes. An example of that would be if you're working for a hospital somewhere where you can do salary packaging. Hospitals get fringe benefits tax concessions that we don't get as normal business employers. But there's some things that are exempt from FBT: laptops, personal computers, maybe not personal computers, PDAs. Now that's an old term for it, but tablets and things like that, you might be able to get a tax deduction for those straight away. So looking at those without any SBT consequences. And then looking at the structure that's applicable to you. So whether it's a trust or a superannuation fund, whether it's an accumulation or retirement phase. We do a lot of reviews of our clients and their structures to make sure we're getting the best result from them from a tax point of view. But we also need to consider whether that's going to be the best structure for them for succession planning and other things as well. So again, it's not just for tax planning, it's also looking at asset protection and other strategies that we might want to employ to ensure that we're getting the best result. But doing a review of structures is really important because things change, legislation change. As I said, because company tax rates coming down, that's making companies more attractive for that tax rate in the company itself. If you're retaining the profits within the company, then reinvesting that within the business. Whereas if it's a trust and it has to come out to beneficiaries, the tax rate might be higher, therefore it gives you less cash available for working capital for the business. So things like that to consider. Now, very quickly, budget recap. And there's not a lot in it from a tax point of view, so I'm not going to dwell on it too long, and I'm conscious of time. I want to wrap up in a couple of minutes. So the work test for voluntary super contributions is going to be repealed. And I'll cover the dates on that very quickly in a minute. So that's for voluntary, not for deductible contributions, only for the non-concessional after-tax contributions. And as Natalie said before, the $450 per month threshold for super guarantee is going to be removed. Now, we don't know all the detail yet, but that's what's planned. There's a downside of contributions. So if you sell your family home that you've held for more than 10 years and you're over 65, you can make an additional contribution to super, which is exempt from all the other rules. That's $300,000 per person. They're changing that to bring the age down to 60 instead of 65. So again, if you've got the family home, now downsizing, you can have an apartment that's a 1-bedroom apartment, and you can downsize to a 4-bedroom mansion, and that will still qualify.
Yep.
That's just the way the rules are. They're very loose in terms of the terminology. Yeah, so that's how it works. But if you're looking at selling your family home and you're over at 65 and 60 when the legislation comes in, then there's an option to put that excess money, because you, in theory, downsizing, having excess cash to the needs of the next property, you can put that into superannuation. So that's something to be aware of. And all the other rules don't apply. So the concessional, non-concessional contribution caps, all that, not relevant to this one. It's a separate concession outside of that. The instant asset write-off we talked about before, they're extending that, and then the temporary loss carryback rules, which I'll quickly go through in a sec. And this is just a quick page of what the different things are. Like this, it's a good infographic of all the different things. There's also an employee share scheme change they're trying to do to make it more attractive to people investing fintechs and everything to try and expand our technology base. Yeah, lots of residency issue we talked about, remove all of that. So there's quite a few things in there as well. The work test, so this is from 1 July 2022, as you said, Natalie. I'm not going to go into all the detail, but that's what they're looking to do, removing the work test, and that also applied to the $450 amount. But yeah, so what they're saying is that if you're aged between 67 and 74, you do not need to satisfy a work test to be able to put lump sum contribution to super, provided you're not over that $1.7 million contribution, that cap. Right? So there's a couple of things to be aware of. So that work test is going. $450, so effective 1 July 2022, removing the $450. Now, I don't know if it applies to people under 18 or not. Because at the moment, people under 18 are not required to pay superannuation guarantee
They
on
have
that.
to work a certain amount of hours per week. So
Yes.
I think the hours are remaining, but the values.
Yes, so that's the thing, but I'm assuming that will apply to them as well. Yeah, that's what I'm too, but I just don't know the detail. We'll wait and see when it comes out. But that's what they're proposing. So that means you don't have that threshold per month. So you're going to potentially cost you more when you're employing casuals and people like that, where there might be earning less than $450 per month. I think it's getting harder and harder for people earning less than that per month now if they're working anyway. So the thing is 300,000 individuals will receive additional superannuation on this basis. The downsizing contribution I talked about before, so they're reducing the age down to 60 from 65, and that's 300,000 per person. So if you in joint names on the title when you sell the house, that's 300,000 for husband and wife. So that's 600,000 all up, so 300 each. So it's quite sizable, but they've both got to be on the title. So that's the issue. So we do a lot of asset protection strategies where only one person's on the title. Sorry.
And it's the concept of downsizing is if your one-bedroom apartment is worth more than your four-bedroom mansion, basically.
Yes,
so it's
correct.
financial as opposed to.
Yeah, but there's no actual there's no terminology about what downsizing actually means in the legislation. It means sell the property when you're over that age, tick, you do what you need to do. Yeah.
So is it worth then, if the title's on us?
Won't hold it for 10 years.
Huh?
Won't hold it for 10 years.
Okay.
So no. Yeah, good thought, but no, you can't. Yes.
You've got to have your name on the title
For 10 years, correct. Yes, you do.
in any period or consecutive.
Period. No, my understanding is before you sell it, it's got to be on the title for 10 years.
You need to satisfy the main residence.
And the main residence exemption as well.
And that's one of the key
Yeah.
things that yeah,
Yes, you do.
it's tricky.
It is tricky, but we've had people do
Well, yeah, I guess it's, if it's, was available for rent first and then you can.
it. Yeah, so there's some rules around that you need to look at. But if it's been not rented at all for that whole time, it's got to be on the title for 10 years.
Okay.
Yep. And as I said, both members of the couple can take advantage of it. Yep. Yeah, so over the past 10 or more years, and self-resident with the super under the measure will count towards the age pension asset test. So that's one thing that does count towards is if you're going for an age pension, it will count towards that. But if you're a self-under retiree, it's not an issue. But it will count towards your asset test because what they're saying is that, and it's the same as the principle applies, that if you're on the age pension anyway and you don't have a property, that money that you might hold in cash is deemed to be an asset for the age pension. But it's a good opportunity for people. And I think what they found is that age is too restrictive. So that's why they brought it down to 60. Temporary, so extension is that we talked about that before, not going to go into detail, but they've extended that from 2022, 30 June to 2023. So definitely a good strategy. Oops, sorry, I'll just go back quickly on that. And from 1 July 2023, unless they extend it again, I reckon there's every chance they'll do it again. Normal depreciation rates will apply, and therefore you only get the instant asset write-off if you've got turnover of less than $10 million. And if you don't have, if your turnover is more than $10 million, then it's only $1,000 worth of deductions that you can get. And other things, so second-hand, so instant asset write-off, the rules are different for second-hand assets. So this is for new assets, so you get that instant write-off. So second-hand assets, the threshold, instead of 5 billion, it's 50 million. So that could affect you. So that has an issue in terms of doing the full deduction for second-hand assets. Pauline, I'm not going to go into, but that's something we do. And then opt out. You do not have to apply these if you don't want to. And that's what I talked about before. If that puts you in a loss and you don't see any benefits of going to a loss to carry forward for future years, you don't have to be knocked down to go into this. So you're not locked
So
into
to just appreciate.
Correct. Yeah, you can. Yeah. And loss carryback. So this one, going to go very quickly, but in essence, the way this one works is if you made a profit in 2019, example, let's say you paid tax of 200,000, and then in 2020 you made a loss of 300,000, then you can claw back the tax you paid in the previous year by saying that, look, I'm going to offset it against, I'm going to claw that back because I made a loss in the next year. I'm going to claw back that tax I paid and offset that against the tax losses I've got in the subsequent year. So this one came in last year, and this is the first year where we're actually going to start utilising this for their clients. But it's a good one if you've had good years before COVID, and then COVID's hit and you've had a bad year. And this is why it came in, because they were anticipating there was going to be a lot of entities that have, might have been profitable before COVID and then go into losses because of COVID. This gives you the ability to claw back that tax you paid in the previous year to offset against those losses. There's certain rules around it in terms of franking accounts and paying tax and crediting and all that stuff, but it's one that can definitely be utilised. And what they've done, they've extended that. It was only going to apply for up to the 2022 financial year. Now they've extended that for another 12 months. So it could be a useful one for clients. We'll be looking at the clients and seeing what we can do regarding it. And yeah, first one to, you can claim it for the first year in this current financial year. So we've got these 3 years tax returns where we can make this claim. Yeah. That is it. Probably a lot to digest, but any questions?
I just want to ask about the concessional super contribution. After the age 65, if you're retired, can you still contribute 25,000?
No, unless you satisfy the work test. Yes. And then they've extended out. If you retire between the ages 65 and 67, they give you a transition period for 2 years. But if you've retired before that, the answer is no. No. So you've got to, so the rule is that if you're over 65, you've got to show that you've worked 40 hours in a 30-day period. If you can't show that, then you're not deemed to be employed, and therefore you don't satisfy that work test, and therefore you can't make the contribution. Yeah. Yeah. So really important one. Yeah, people again get called out on, unfortunately. Yeah. Lot to digest. Any other questions anyone has? No? Chelsea, anyone on the chat that's got any questions?
Yes, we've just had one come through from Mike.
Yeah.
So he'd just like to check that the JobKeeper payments this financial year are the same as last year. That is non-taxable income.
JobKeeper.
JobKeeper, yes.
JobKeeper is assessable. Yeah. So it wasn't tax-free. Cash flow boost was tax-free.
Yep.
And also government grants, Victorian government grants, and I forgot to check this beforehand. I can't remember the date, but from September.
It's 29th of September.
Thank you. So from the 29th of September 2020, if you received any Victorian government grants or New South Wales, whatever grants they are, state-based one, they were exempt from tax beyond that date, but before that date, they were assessable. So JobKeeper definitely taxable. Cash flow boost definitely non-taxable. Government grants from state governments depends on the date in which you claim you receive the grant. So that's how it works. And again, without going into too much detail, the joys of running through a company, if you get the cash flow boost through a company, because you get that as tax-free, that can potentially create what we call unfranked dividends within the company, because there's no tax credits, therefore it won't be a fully franked dividend when it comes out. And that might then create a tax liability for the shareholders at the end of the day. So again, a bit of smoke and mirrors, the government will get back their tax back eventually. So even though they say it's tax-free, ultimately it's not. So you just got to be aware of that too. Yeah. Any other questions, Chelsea?
No, that's it so far.
Great.
And if there are any more questions for the people on the Zoom, they can reply and email tomorrow. Same with you guys. If you go home and think of another question, just shoot us an email.
Okay, so that's it for tonight. So thank you everyone for coming. Thank you for all those people online, and hopefully, even though I kept drifting over this way, apologise for that, but hopefully it will all worked out well for you. We'll be here in the office for a little bit longer, so if anyone who wants to stay can ask some questions, we're available. But yeah, thank you one and all for coming, and have a good night and enjoy the rest of the financial year.
Thank you very much.
Thank you.